turnover ratios, let's quickly first look at the definition of turnover ratios, and then we'll try and understand what they actually mean. So when we talk about turnover ratios, we have something called receivables turnover ratio, which is given by credit sales divided by average receivables. We have inventory turnover ratio, which is given by cost of goods sold divided by average inventory. And we have payables turnover ratio, which is given by purchases by average payables. Now the trick here is to understand that most of these are effectively, in a sense, showing the efficiency of the firm. Now how efficient is the firm is what this shows most of the times. So that's basically what this ratio would mean. And effectively, if you look at this sense in general, what it means is effectively that how much of the credit sales is effectively outstanding as receivables. Fine, so that gives a proportion which is relevant. In case we do not have credit sales available, we use something like sales by receivables in this case. If we do not have data on purchases available, we can also use COGS by payables here. I will explain what this means in a moment. This will become clearer. But in a sense, it gives us an efficiency of the firm on how quickly are they turning over their receivables. If cost of goods sold of a firm is 1000 and average inventory is 200, it effectively means that they keep 1/5 of their annual cost of goods sold as inventory at any points of time. Or in another sense, they basically are able to offload the entire cost of, entire inventory. So offload inventory, how many times? COGS by inventory, which is 5 times in this case. So effectively, the higher the number, the better the efficiency of the firm. That's what we are looking at in terms of understanding turnover ratios. Now turnover ratios can also be shown in terms of days notations. So we have things like days sales outstanding, days inventory outstanding, and days payables outstanding. What do? We effectively take 365 and divide it by the respective turnover ratio. So if we are looking at receivables, we will take receivables turnover ratio. If we are looking at inventory, we'll look at inventory turnover ratio. Now, what does this mean effectively? So let's try and understand that using an example. Let's take receivables is 365 by receivables turnover ratio. What does this effectively tell us? Let's assume there is a company that has sales of 365 crore. Fine, annual sales of 365 crore. Let's assume they have receivables worth 30 crore. What does this effectively mean? If I were to find out per day sales of this firm, this is equal to 1 crore effectively, correct? Crore is equal to 10 million. So 1 crore is equal to 10 million. So effectively I'm using this notation here. So per day sales would effectively work out to be 1 crore. Now, what does this mean figuratively? If you start selling on day 0, and this is the timeline of the firm, what you sell on day 1 is in general received on day 31. What you sell on day 335 is in general received on day 365. Whatever you sell after this, 336, 337, 338th day, will be received in the next financial year. It will not come in this financial year, correct? So this means that while you sell 1 crore every day, which accounts for 365 crore worth of sales, you collect only 335 days worth of sales. The rest of the sales is outstanding. If you calculate your receivables days outstanding or days sales outstanding, in this case your receivable turnover ratio would be equal to, since we do not have credit sales, sales by receivables, and when you divide 365 by the receivables turnover ratio, this gives 365 by 30, which will be equal to 30 days. So effectively your days notation gives you an answer of 30 days, which in a simple sense tells you how many days after you sell on average will you receive the money. That's what days notations tells you. Fine. Effectively, if you look at inventory days, that means how many days after you received the raw materials were you able to sell it eventually. If you look at payable days, it effectively tells you how many days after you purchased the stuff did you make the payment. Fine. So that's clear. We look at receivable days in this sense. We can also kind of calculate it by, effectively dividing your receivables. You can rearrange the item by sales per day. That's what you're using here effectively, correct? So receivable is 30, sales per day is 1, that gives you 30 once again. So you can use either of the formula, they're one and the same thing. It's rearranging of the terms, which gives me the day notation effectively. Fine, so I can calculate the day notations based on this. Let's assume there is a firm whose day notations here is 30 days, which means 30 days worth of sales is outstanding as receivables. 20 days worth of inventory is outstanding as, inventory. 20 days worth of COGS is outstanding as inventory. And let's say 15 days worth of COGS is outstanding as payables. Now, how do you deal with this, or how do you understand this? When you look at operating and cash conversion cycle, let's understand this bit first. So you have a firm which purchases inventory on a particular day. After 20 days of the inventory purchase is when it is able to convert it into a final good and sell it. Once it sells it, effectively, at that point of time, you assume that goods have been sold, which is after 20 days. After 15 days, they make the payment. So while they purchased this on day 1, they were able to sell the raw material converted into final goods after 20 days. They made the payment on the 15th day to their vendor. Correct? Now, let's assume once the good got sold, the money got received after 30 days. So that's what we had seen. So effectively, what you are saying is that in this context, you have this kind of a cycle of 50 days, which is known as the operating cycle. What is the operating cycle? In terms of days sales or days outstanding, what is the time taken from the purchase of the raw material to receive the money? How do you find it? You effectively add your inventory days to your receivable days to get the operating cycle. In our example, this was 50 days. If you go ahead and look at this period, now just note this period carefully. What does this mean? What we are looking at is something that gets paid out after 15 days. So the company has made the payment after 15 days. They receive the money after 50 days. For 35 days, they have to fund the business. From this point till this point, they do not have the money. So maybe they have borrowed money from someone to pay it, and then they repay the money to this person after 50 days. So effectively, they have to fund the business for 35 days. This is known as cash conversion cycle. Now, logically speaking, smaller the cash conversion cycle, better it is for the firm, because they have to fund for a smaller period. Fine. So if they have to fund for a smaller period, the better it is. In fact, there could be a case where inventory days are 20, receivable days are 40, and payable days are 80, which means when you get the good, it takes 20 days to convert it to finished goods, another 40 days to recover the money, but the company only pays after 80 days, which means effectively, even after you have received the money, you earn interest on this money for 20 days before paying it to your supplier. As long as the company can maintain this scenario by choice, this is a good scenario to be in, because you are making money on the money you have already earned. Whereas in the first case, you have to fund the business for that period, which is the cash conversion cycle. So operating cycle is effectively this entire period. So if we were to look at operating cycle, give me a second. If we were to look at the operating cycle in this context, operating cycle would effectively be 20 plus 30 days, which is this period. This entire period is the operating cycle. This period for which the company has to fund the business is known as the cash conversion cycle.